Okay, let's unpack this. Welcome back to the deep dive. We cut through all that financial noise to really give you the essential stuff you need fast. Today, we're diving into something that, well, it impacts everyone, doesn't it? Whether you're just starting out saving or, you've been doing it for years, your
Yeah.
emergency fund. Look, you want to know where to actually keep that safety net, right? And you want to know it quickly. So our mission today, show you exactly that. We've looked at a whole stack of insights from financial pros to guide us.
And it's about time, isn't it? Because, what's fascinating here is we always talk about how much, that 3 to 6 month thing. But the where, that's just as critical, maybe even more so for your actual peace of mind. Think about it. Your emergency fund, it's got to be safe, obviously. Accessible, like right away. Needs to be separate from your everyday cash. And yeah, ideally earning a little something, but without taking on silly risks. So this deep dive will help you find those ideal spots.
Absolutely. It's not just a number, it's a strategy. Right. So let's think like financial detectives for a sec. When we're looking at where to stash this emergency cash, there are a few core clues we need. First, safety. Like, number one priority. This isn't gambling money. Second, gotta get to it fast. Like, really fast when things go wrong. No hoops. Third, separation. Keep it away from your checking account, so you don't accidentally spend it. And fourth, maybe a little bit of interest, just enough to kind of fight off inflation a bit. Stability, that's the name of the game here. Not high returns, just rock solid security for this particular pot of money.
It's exactly. That's the core of it. Protection and immediate availability.
Uh,
And if we connect this to the bigger picture, look, this fund isn't about getting rich. Nope. It's your financial shield. Gives you that peace of mind, that resilience when life, throws you a curveball. We want you to avoid those awful spots where you're forced into bad decisions because your emergency money vanished in the market, or it's just stuck somewhere. Imagine losing your job or a big house repair hits. That's when this money saves the day, stops a crisis becoming a catastrophe.
right, that difference between getting rich and just staying secure is huge. So, okay, with those basics down, where do the experts point us? Here's where it gets really interesting. Because this one, pretty much the gold standard according to a lot of financial pros. The high yield savings account, HYSA. Usually from online banks, credit unions, they're kind of the champion for this stuff.
Oh, absolutely. A really strong contender. And the pros are pretty clear. Safety first, right? FDIC insured. Or NCUA if it's a credit union. That's Federal Deposit Insurance Corporation, National Credit Union Administration. Protects you up to $250,000 per institution, per depositor. Basically, if the bank goes bust, the government makes sure you get your money back. That kind of safety is non-negotiable for emergency funds.
Yeah, that government backing is massive. I remember when I first got that total aha moment. Okay, safety check. What about getting your money out? How quick is quick?
Good question. Usually you can transfer it online to your main checking account. Takes about a day or two typically, so it's not like cash instantly in your hand, but it's definitely fast enough for most emergencies that aren't happening, right this second. And the big thing, the interest rates are competitive. Sources suggest right now you might see around 4% APY, annual percentage yield. That helps your money grow, keeps pace with inflation a bit better. Huge plus compared to like regular savings accounts.
That 4% APY, yeah, that sounds pretty good, especially compared to the 0% we used to see. But let's be real. How likely are those rates to stick around? How do you factor that changing rate into your choice?
That's a really important point. And it circles back to that modest growth idea. HYSA rates, yeah, they do change. They follow the wider economy. But the key isn't trying to guess the absolute peak rate. It's knowing that even if it drops from 4% to 3%, maybe even 2.5%, it's still going to likely beat the pants off a traditional savings account that's stuck near zero. So you're always aiming for the best relative return you can get on safe, easy-to-access money.
That makes sense. Something is definitely better than nothing. Okay, any downsides to HYSAs? What's the catch?
There can be a couple of things. Sometimes you hear about withdrawal limits, maybe 6 per month. That used to be a federal rule, Regulation D. It's actually gone now for savings. But some banks still have similar internal limits. But honestly, in a real emergency, you're probably not making dozens of withdrawals anyway. So it's usually not a big practical problem. The real challenge, honestly, it's behavioral. It's that mental discipline. Because the money is pretty easy to get to. The temptation to dip in for non-emergencies, it can be strong. You got to consciously remember, this isn't for pizza night. It's for, actual financial rescues.
Yeah, that mental discipline thing is so true. So easy to justify something that isn't really an emergency. Okay, so closely related, the money market account. MMA. How's that different?
Right, MMAs.
Yeah.
Very similar to HYSAs in a lot of ways. They also
Ah.
have that FDIC or NCUA insurance, often similar interest rates too. Pretty competitive. But the key difference, a bit more flexibility usually. MMAs often come with like a debit card or even check writing privileges.
Ah, okay. So even faster access than just an online transfer.
Potentially, yeah. For paying something directly. Think about maybe a natural disaster, knocking out online stuff for a bit. Or maybe you need to pay someone who only takes checks right then and there. You could just write a check or use the debit card. It's just a different kind of accessibility. The downsides are similar, though. Those withdrawal limits, maybe 6 a month, might still apply. Sometimes MMAs need a higher minimum balance to avoid fees, too. And again, discipline. Huge. Just because you have the card doesn't mean it's for your morning coffee. Still got to be for emergencies only.
Mm-hmm. This raises an important question then for you listening. Which one works better for you, the HYSA or the MMA? What's the right balance of access and protection based on your own habits? Do you like that quick online transfer? Or does having a debit card or checks for direct payment feel, I don't know, more useful for how you think about emergencies? It really comes down to how you see yourself needing the cash and what kind of mental guardrails help you keep it safe. That's a really good way to think about it. Okay, let's switch gears a bit. Let's talk about some more familiar options and maybe a smart strategy. Lots of us have accounts at our local bank or credit union already, right? And just having a dedicated savings account there, that could still be a decent option, especially maybe for part of your fund. The pros: simplicity, safety, it's easy.
And crucially, you get that psychological barrier we talked about just by having it in a separate account, even at the same bank. Behavioral economics calls it mental accounting.
Mm-hmm.
It works. Your brain kind of puts that money in a different box, makes it feel less available for just random spending, even though you could transfer it. You see it there, separate from checking. Less temptation for non-emergencies. Plus, yeah, instant transfers to checking, or you can walk in and get cash. Super convenient.
That mental accounting idea is pretty powerful, isn't it? So it's not just willpower, it's using how our brains work.
What's the main downside then for these local bank savings accounts? Yeah, the big one is usually the interest rate, or lack thereof. A lot of the big traditional brick-and-mortar banks, they often pay next to nothing on standard savings, like close to zero APY. So your money just sits there. Doesn't really grow. Inflation kind of eats away at it slowly. So yeah, it's super convenient for access, but you're probably leaving money on the table interest-wise, especially if your fund is decent-sized. If convenience is everything and the amount's small, maybe okay, but for better growth, linking it to an HYSA is almost always better.
Makes total sense. And here's a super simple tip wherever you keep it. Nickname the account emergency fund online. Just seeing that label, it's another little mental nudge, keeps the goal front and center. Okay, now let's touch on something a bit more advanced maybe. No penalty certificates of deposit, CDs.
Ah, yeah, the no penalty CD can be a clever little tool for a slice of your emergency strategy. So a normal CD, right? Locks your money up for a fixed time, 6 months, a year, whatever. And you pay a penalty if you pull it out early. But the no penalty kind, like the name says, you can take the money out without losing interest, usually after a very short initial period, like maybe the first week. And they can sometimes pay a little bit more interest than a regular savings account, maybe even a touch more than an HYSA sometimes, especially for shorter terms.
Sounds okay for a little extra return, but what's the catch, especially for emergency money?
The main catch is usually liquidity. Still, even with no penalty CDs, you often have to withdraw the whole amount, not just part of it. So, say you need $500 for a quick car fix, but you've got $10,000 in that no penalty CD. You might have to pull out all 10 grand, then figure out where to put the rest back. It's just not as flexible for those smaller partial needs and traditional CDs. With penalties, generally a hard no for emergency funds. Liquidity is just too important.
Right, that's a really key difference. So you probably wouldn't stick your entire emergency fund in a no penalty CD, which kind of leads us nicely into this strategy idea, the tiered approach.
Exactly. The tiered approach is a great way to balance immediate access and getting a bit more growth. How it works is you keep a core amount, say 3 months of your expenses super liquid, in an HYSA or maybe an MMA, ready to go instantly. Then maybe for the next chunk, another 3 months worth, perhaps the money you think you'll need less quickly. That part could potentially go into a no-penalty CD to earn a little extra interest. It's about matching where the money is to how quickly you might realistically need it.
That's a smart way to balance speed and return.
Yeah, and what's fascinating here is how these different options really suit different people, different comfort levels, different needs for access. That CD strategy, it's clever for earning a bit more, sure, but you got to remember, emergencies are, well, Emergencies, they don't follow schedules. You might think you won't need that second tier for 6 months, and then bang, something happens next week. So never lock money away, even in a no-penalty CD, if you aren't truly okay with it being slightly less accessible, because you just can't predict the timing. I mean, my water heater finally died last winter. On a freezing morning, of course. That kind of sudden, gotta fix it now expense. That's exactly what this fund is for, and having it accessible instantly was just such a relief.
That's a perfect example. It's really not if something happens, it's when. And it reminds us, while we talk strategy and rates, the real value is that emotional peace of mind. Knowing you're prepared is honestly priceless. So true. Okay, let's quickly hit a couple of niche things and then really hammer home what not to do. First up, money market mutual funds. Let's be clear. This is not the same as a money market account. People mix these up all the time, these mutual funds. They're offered by brokerage firms. They invest in super short-term, low-risk stuff like government T-bills.
And they're generally seen as pretty safe, yeah. Easy to turn back into cash. And sometimes they can yield competitive rates, maybe even better than bank accounts if interest rates are generally low. Could be handy if you already have a brokerage account set up. Makes redeeming shares quick within that system.
Okay, but here's the absolute critical point, right? The one people often miss. They are not FDIC insured like bank accounts. What does that actually mean for your emergency stash?
It's a massive difference. Huge. Because they're investments, not deposits.
Okay.
Even though they're low risk, a money market mutual fund, unlike an account, could technically lose value. It's rare, but possible. Happened back in '08 briefly. Or in really extreme situations, they can pose withdrawal gates, meaning you temporarily can't get your money out. So for most people, that extra layer of government insurance you get with a bank or credit union account, it's just worth it for the emergency fund. Plus, sometimes moving money from a brokerage takes an extra step or day compared to a simple bank transfer. So yeah, for most folks, sticking to insured bank accounts for this specific purpose, probably the simpler, safer bet.
Okay, that really clarifies things. Next up, actual cash, like paper money at home. Is there any place for that?
Yes, definitely. But a very, very limited role. Keeping a small amount of physical cash, maybe a few $100 somewhere secure at home, like in a fireproof safe. That could be really smart for immediate, like right now, emergencies. Think power grid goes down, ATMs don't work, or a natural disaster hits, disrupts electronic payments, or maybe you need to evacuate quickly. Need cash for gas, maybe a motel room on the road.
So tactical cash, not the main fund.
Exactly. This is key. Do not keep your whole emergency fund stuffed under the mattress. Cash at home can be lost, stolen, destroyed in a fire. It's not insured. Once it's gone, it's gone. Plus, earns zero interest. And let's face it, it's just sitting there tempting you to spend it on something else. So a little bit for those true immediate system down scenarios, smart. But the bulk of the fund needs to be safe and sound in an insured account, earning something.
Excellent practical advice there. Okay, this brings us to the big don'ts. What should you absolutely avoid for your emergency fund? If we connect this back to the bigger picture, right? The theme is always liquidity, safety, access. Prioritize those. Anything that compromises those for a slightly higher return. Or makes the money too easy to grab for non-emergencies, it just defeats the whole point. So what are the major red flags? The big no-nos.
Okay, number one, volatile investments. Things like individual stocks, bonds, crypto, anything risky, generally just a really bad idea for this money. Yeah, the stock market might offer higher potential returns over the long run, but your emergency fund needs to be there, guaranteed, when you need it. Not tied up in something that could suddenly drop 20% in a bad month, or worse, tank during a recession right when you might lose your job. You absolutely never want to be forced to sell investments at a loss just because you need the cash right then.
Makes total sense. Stability, not growth, is the goal here. Okay, what's another common trap people fall into?
Number two, don't keep your emergency fund just sitting in your regular checking account, the one you use for groceries and bills. This is probably one of the most common mistakes we see. It just makes it way too easy to accidentally spend it. People who mix it all together, the lines get blurry. That emergency money suddenly pays for a weekend trip or a new gadget. Keep it separate. Use that mental accounting trick we talked about. Out of sight, out of mind, basically. You're much, much more likely to leave it untouched until a real emergency hits if it's in its own designated spot. Simple psychological hack, but incredibly effective.
Yeah, it's like having a separate envelope for rent money. You just don't touch it for anything else. All right, what's the final major place to avoid?
And finally, be really, really careful about thinking you could just tap into your retirement accounts, like your IRA or 401k. These accounts come with hefty penalties, often 10% penalty, plus your regular income tax if you pull money out before retirement age. Ouch. That means they're absolutely not designed for emergency liquidity. They're for the long haul. So the bottom line through all of this, liquidity, safety, access. Always. A high-yield savings or a money market account. They usually hit all those marks perfectly for most people. Helps you avoid these costly mistakes.
All fantastic, really critical advice. Okay, before we wrap this up, let's just quickly mention a sort of parallel fund. It's specialized but can be super useful for one particular type of emergency, the Health Savings Account, or HSA. If you happen to have a high deductible health plan, you might be eligible for one of these.
Yes. HSAs are a pretty unique beast in the financial world. Really powerful. The biggest advantage, that triple tax advantage you hear about. Contributions often go in tax deductible. The money grows tax-free. And withdrawals are tax-free too, if you use them for qualified medical expenses. That makes them an incredibly efficient way to save specifically for unexpected healthcare costs.
Okay, sounds amazing for medical bills, but crucially, it's not a replacement for your general emergency fund, is it?
Exactly right. Super important to stress that. An HSA is a supplemental tool. It's not your main all-purpose emergency fund. It's specifically for medical stuff. And there are strict rules. If you pull money out for non-medical reasons, you'll face those same taxes and penalties we talked about with retirement accounts. So know its purpose. It's a fantastic asset for healthcare costs if you have one, but keep it distinct from your broader safety net.
Got it. Okay, so what does this all mean for you listening right now? It means you've got clear, actionable steps you can take to make sure your financial safety net is solid. We've seen that high-yield savings accounts, maybe money market accounts, are generally the top choices. They balance safety, access, and earning some interest really well. Remember how important it is to keep those funds separate from your daily spending.
Yeah.
Even just labeling the account helps reinforce that mental barrier. You can totally do this.
Absolutely. And maybe just a final thought to leave you with. Take a minute maybe later today and just review where your emergency fund is right now. How does it stack up against what we talked about? Because ultimately, the best place for your emergency fund, it isn't just about the absolute highest interest rate you can find, It's about the place that guarantees the money is there. Safe, untouchable for daily stuff, growing a little bit, ready precisely when you need it most. It's about finding what aligns with your own discipline, what gives you that real peace of mind. So the question is, what steps can you take, maybe even today, to make your emergency fund work harder and smarter for you?